I'm Jared Johnson, and on this episode of the Stock Market Playbook, we have Nik Lentz, UFC fighter turned market investor. This is a great episode. I think you guys are going to love this. He talks about the why, the background he came from, how he turned into an investor, and what he needed to know to feel comfortable about putting his money at risk in the market. You're going to love this episode. We're going to pass it over to Nik right now. Enjoy. All right, Nik, thanks for joining us on the podcast today. Happy to have you.
For sure.
Great to get to know you. We always love having new guests on here. We were chatting at the beginning before we started recording about some interesting things that I want to hear more about. But before we get into that, for all of my listeners that are hearing you and kind of seeing your face for the first time, give us a little bit of background. What's your market specialty and how did you get here? That's always a good broad question, but I love to hear people's path.
Well, growing up, my family had zero financial background. They were very broke, so they didn't know where they're going to get the next $10 from, much less where to invest it. So finance was the farthest thing from like my life. And eventually I moved away from that situation and I moved up to Minnesota with my father and moved into a different family. And he got me into wrestling. And so I started wrestling, and then that got me a scholarship to go to college. I went to college and then after that I became a professional fighter. And so I was a professional fighter for 15 years. And
so now backing that up a tiny bit, what did you study in college?
Well, I actually went to school to be a doctor. So I was going to school to be a doctor. Yeah, and then it was going fine. Like everything was going fine. I've done podcasts about like the situation there, but for whatever reason, I decided to drop out and become a professional fighter. And so don't make that business decision. If your kids ask you that, don't do it. It worked out for me, but obviously it was the wrong decision. You shouldn't do that. But it worked out really well. And in the middle of my fight career, I was introduced to investing and stuff like that because I needed somewhere to put the money. And right as I started to make money was right in the 2008 crash. So as everyone is losing their money, this is the first time in my life that I ever had any. So I was like, wow, this is kind of like an odd situation here. Like everyone I know is going broke. And for the first time, I'm the one with the money. And so I needed to figure out a place to put it. And what a great time to have money to spend, because everything's crashing. And so.
Yeah. You could buy, I don't know, anything and just hold on to it and kill it.
Yeah. So I didn't know what I was doing, but one thing I always have been pretty good at is I don't want to say like be a fool, but I've always been good at like playing the fool and finding smart people that are good at the thing I want to be good at. And so I because of my fight career and because I had an into that situation, I found guys that were in the investment business, very high level guys. I won't say their name, but people that you would normally go up to and they would say like, hey, leave me alone. Like you could never get in contact with this level of person. And because I had a fight career, we'd go out to the bar or we'd meet and then they offered to help me out and to teach me the business. And then for the next 10 years, I did that over and over again. And I was able to get some of the best mentors in the game. And I was able to...
By the way, who in the world has a fight career, connect with investors, become an investor like story? That is totally wild, which I love, by the way. Curiosity, what kind of fighting were you specialized in?
I was in the UFC for 12 years.
UFC? What?
Yeah. Yep. Man, I was in the UFC for 12 years. Yeah.
Just wild. So obviously UFC is everywhere and everything and just huge. Yeah. That is so, and you were like kind of earlier days UFC. So when did you kind of exit the UFC side of things?
Well, I didn't retire till about 4 or 5 years ago, but I did start a lot earlier. I started in 2007-ish, around that time, with getting up to the UFC level. I started really fighting in 2004.
Wow. Wow. And UFC went on quite the tear from those early 2000s to what most people know it as now. I mean, it was, I remember watching UFC stuff when I was like, some of the stuff in the 90s,
Yeah.
because it goes way back, right? And some of that stuff in
Oh
the
yeah,
90s,
yeah.
they would put like some small skinny boxer against like some
Yeah.
mass. There was just no weight limits. There was no
Yeah, yeah.
anything, right? They just two people fight it out until somebody gives up. And now it's like this huge, I
Yeah,
mean,
it's definitely a different game these days, but yeah, I've
that's
been I've been through that whole ride, so
that's wild. And so in that process, you meet some investors, some fund managers, some guys in the
yep.
business, and so they turned you on. So what made you think I really want to do this myself instead of, hey, I've made some good money fighting, good money doing this. I'm just going to give it to these guys that, have a whole career in this business. What kind of, did you just like the markets? Was it an interesting place for you?
Well, one, I liked it a lot. It fit into just my personality. I have an obsessive personality, so like I just started to learn about it, and then thankfully, like all people who start trading, like you can go kind of. It seems there's two routes. One guy, he gets knocked out right away, and then there's another moron like me who hits it out of the park. So it's like you're instantly attached to it because you're like, oh crap, I can make this much money doing something like this. Like this seems like a lot better than running a gym or trying to grind myself into something else after fighting. So I always knew I had to do something after fighting. I always knew that I had to do some type of business. And especially for someone like me who got into the professional sports, I'm a very introverted person. I don't like to be in the public eye. And so like this was a way that I could just be myself. I didn't have to sell myself. I didn't have to start a gym. I didn't have to deal with like I mean, obviously if you're trading, you're dealing with, you're working more than a normal person, but
Yeah.
I didn't have to do like that side of the game or with the advertising or the social media or all that stuff. I could make my own money. And so I was really, really, really attracted to that. And so like I was like, that's the effort I wanted to go to. Now, currently I work privately with hedge funds. I code systematic models. I work with Andy Constant at damspring.com. And so I didn't know if I could ever get into the business because the fighting itself is sort of like, why would we listen to a fighter or why would we invest in somebody like that? So I never assumed that I would get into that side of the business because I just didn't think people would take me seriously. But thankfully, I'm pretty good at it, and the more people that are around me, the more that they will invest in me, and they saw that the work ethic actually paid off. So that's how I got into that sort of that side of the business as well.
That is awesome. That's such an interesting story. I mean, we have lots of guests on here, and people have varied backgrounds, but UFC fighter, man, that's super cool. So, and it's, I think it's a good reminder that any business, doesn't matter what it is, right? Fighting, the stock market, being a doctor, being a car salesperson, whatever the thing is, it's about being a good person and being trustworthy and being a hard worker and being honest, and whatever it is, that transcends all. So it sounds like you did great there. Now you get into the stock market, you get into the whole trading side of things, and you've kind of gone the quant route, right? You're into
Correct.
kind of systematize trading and quantitative strategies. Tell us a little bit about that. Why did that? Did that just kind of connect with your personality? You said you really like to kind of hone in on stuff and to have something be very systematic. Did that fit you? Why'd you go that route?
Well, when I started, obviously you don't know what you're going to do, right? And then so obviously it's like, am I going to be an investor? Am I going to day trade stocks? Am I going to trade stock industry futures, oil, currency, FX, whatever you're going to think about, right? You have to kind of find what fits for you. And I started with the stock market. And so I did pretty well in the stock market, but I had this idea like I wanted to be able to bet on like other world events and use macro and things like that. I wanted to not just be a stock guy, because I kind of looked down on that. I was like, I didn't want to feel like I was just a stock guy, which is stupid, but but I was like, I don't want to be that guy. I want to be the guy who knows what's going on in the world and can bet on it and do those kind of things. So I spent a few years studying currency markets, bond markets, all that kind of stuff. And then eventually I came around to these guys, this like group of traders that were bond traders, stir traders, bond traders, and they were very good, like savage traders, just making tons of money and stuff like that. And one of the things that they did is they traded like they were always trading like, and I would be like, why are we doing this? And their answer was really like, well, because it works. And I was like, but why are we doing it? And then it was just sort of like, because it works. And I was like, that in my mind, it was hard for me to scale up the investing. Like I could do it at a lower level, but once I had to start spending larger amounts of capital to try to scale up my earnings without having that backdrop, I didn't have like you need iron nuts to do that. And I didn't have them because I didn't, the thought process didn't make sense to me. So well, I was looking for the reason, and there was no reason. They were just like, well, this is the technicals. Is this extended? Like this thing's going to happen in the bond market, this situation. And it just wasn't enough for me. So I tried to build my own system around it to give me the confirmation. So I slowly started. I used to sit here like for like 3 hours a day, and I would write all the stuff down on paper because I didn't know how to code or anything. And I would do the math by myself. And, it would take forever to do, but I started building like these mental models. And then eventually it's like, people were like, well, you could code that. And then, so I started doing basic rudimentary codes to do it faster and making my own indicators and doing stuff like that. And then eventually it's like, oh, okay, like now I can see the why behind this. So like, why is the bond market doing this? Why is it? And then I can add the macro factors. I can add the technical factors. I can add the different spread factors. And then, and back then it was a little more difficult because if you got a book on quantitative investing, I mean, you had to have a physics degree to read the thing. So, and with no background, it was very difficult for me to do that. But as I started to do that and get into the process, it became a lot easier. And then eventually when I could make my own codes, it became a lot easier. And then with that backdrop, all of a sudden I had the confidence to take the trades I needed to. And if they didn't work out, I didn't care, right? And I didn't spiral out of control mentally. I had the backdrop, the reasoning. And so I had to have that. A lot of people don't need to have that. But I had to have a lot of the why had to be in my process in order for me to be able to take the trades and to bet the money that I needed to.
I think that's super interesting because there's a lot of people that say, okay, doesn't matter the why. And I've heard this. I've been in the markets for 25 years, right? And there was one trader out there that used to always say, do you know why things went up? Because there was more buyers than sellers. And I'm like, you son of a gun, yes, obviously, but what is happening under the hood? And I can 100% identify with that we may never know exactly why something happens, but if we can get a general framework, I love how Howard Marks puts it, right? And if you've ever read Mastering Market Cycles, right, which is a great book of his, and he just says, look, we can't predict the future, but if we can understand everywhere where we are right now, we can have a pretty good idea of where things might be headed. And that can sometimes be the why, right? Just understanding what is happening here now, what the numbers mean, how they correlate, what triggers, what warning signs, whatever there is, we have just a much better probability ahead of us. And that's all trading is, right? It's just doing something that has the best probabilities because we never know what's going to happen.
And even to that, like you're overlaying probabilities that don't exist, right? Because the function itself is too complex to map, right? Like you can't map 3 different bodies rotation with gravity knowing everything, right? Like you can't even map that. And you have a system with millions of inputs every second. So there's no way to master that. And so that's another thing, the risk management side. It's like that was another hurdle for me. It was like, well, like you just gotta make 2 times more than you bet. It's like, okay, well, how do you do that? Like how do you decide how big it's going to be? How do you decide how small it's going to be? Is that really true? And one of the things that really like got me into quantitative events is once I started tracking my stats. I had a year, I had like a stretch of like 6 months where I was 70% right and I lost money. And I was like, how is that possible? How can I be right 70% of the damn time and still lose money? And so I had to like, so I came up with like, again, like on paper, and I would do these like crappy models and stuff. And I was like, well, if I had tighter stops and I lost like 50% of the time, but I was able to increase the winning or whatever, then maybe it would work. And to this day, that was one of the biggest achievements I ever did in trading. And now, I kind of hunt for like a 40% win rate, which is crazy. And so it's like that type of systematic ability to dissect it all up, to figure out where you fit in the process. And then at the same time, like I said, some people can do it, but I couldn't do that. I couldn't lose 2 out of 3 trades and not have the math behind me, or not have some type of system that's saying like, hey, in the long run, this is going to work out. Because it's easy to say that, but when you get 10 wrong in a row, like
you start questioning things.
Yeah, you start losing your mind. And I didn't want to. I had to have some system to make it so I couldn't do that.
No, that's, and I think a lot of traders, especially when you run a bunch of back testing, right? And you dive in, you look through all your back testing, you say, okay, this lost 20 times in a row, but look how well it did in the future. But nobody thinks about, you're sitting through 10 or 20 losses and you're going, I have screwed up. This is a worthless system. I'm scrapping it, right? And so it's real easy to fast forward through that in some back testing. But when you have to actually sit through that, it is a very different experience. And so, and likewise, like you're saying, you can have a great win rate, but if your losses are big and your wins are small, you could still be losing money. And, and it's not enough to just say, hey, I'm going to take small losses and huge gains, because you can say that, but you have to have a system that backs up something that actually takes small losses and can find big gains. And trading is such a funny, wild, interesting thing. And it's only been accelerated. I'm always interested to hear how AI and some of these, AI coding agents are helping people like yourself that are really into the quantitative side and putting all the data together. Are you doing much in that space?
Well, yes, to a degree, and no. So it's actually it's somewhat it's an absolute gift to people who know what they're doing. If you know what to look for, if you know how to use AI, it's so awesome, because like what would take me 2 months, I can do in a day. But I'm able to spot the problems. I'm able to see when it goes off track. I'm able to see when it messes up, when it deletes something, when the back test comes back too good, and you go back and you look and you go like, all AI does is it tries to make you happy. So if it thinks that like a better win percentage will make you happy, it'll find a way to put it in the code to get it in there. So you really have to dissect it, and you have to sort of know what you're doing. But if you can do that, oh my goodness, it's been such a lifesaver. And also, like, anything I think of, I can now test rather quickly. So it's like before, it's like I have all these pieces of code, and then I'd have to say like, okay, have I done this in the past? How are we going to set this up? How are we going to make like the kind of like a rough draft of the code, like kind of, you don't write it, but you sort of have like a little bit of a rough draft, and then you have it mapped out. Whereas now I can just, because I have multiple AI systems, and it knows all the codes I've already done. So it knows how I like to do it, how I like to see it, what I'm going to do for. And so if I just have an idea now and I type it and I say, hey, this is what I want, it'll give it to me within, seconds. And, so it's increased the speed dramatically. The thing that it screws up a lot is, like I said, you'll have these random things where it'll change something it's not supposed to, where it messes it up. So you really have to be like a really good proofreader. And so a vibe coding essentially is going to get a lot of people in trouble if they don't know what they're doing. So if you don't know, like if you don't know how to look at a back test and it like just looks too good, or if you try something and like it's everything is just working too well, and that happens all the time when we need back tests. You're almost like you kind of want it to come back bad. You want it to have mistakes because it's a lot more real then. And the vibe coding is going to get a lot of people into trouble in that because it's going to make these systems that they think are somewhat concrete or somewhat good, and it's missing all the actual underlying factors that are important. So in the right hands, it's an absolute gift from God, but in the wrong ones, I think it's going to cause a lot of people a lot of pain.
I think this is a great time to bring into the discussion the side of, just like you said, AI wants to make people happy, which is true. It's trying to predict on all of the stuff that we input into it what we want and need and are going to say and are going to do, right? And I especially for any kind of coding you're doing, market related and trading and back testing and so on, you have to go with version number 3 or 4 or 5. People love to put something in, it comes back, it looks good, it makes sense, everything's clean, great. I'm on my way. And you have to stress test this stuff in whatever it is, whether it's coding, whether it's just in a response of a plan you're trying to make for your trading or analyzing your whatever. It should be a tool, but it can't really replace the thought process. In my hedge fund right now, we have quants that, not that long ago, I would say, hey, we need to back test this, we need to run this, and it would take days and weeks. And now I can say, we need to create this, we need to, back test and run this, and it's hours. And it's
it's awesome. It's awesome.
It's amazing, but it's certainly not something that you say, hey, make me a thing. Great, thanks. Like it's got to be something that does the steps. I'm not a coder. My quants are. You have much more coding experience than I do, but if you know what you're trying to accomplish very specifically, then the coding bridge that it that gap that it bridges is so powerful. So it's great. So tell us a little bit. So what are like your top, like what are the things you look for in the market? What gets you trading? I mean, how many times are you in and out in a day? 100, 1,000, 3? I mean, what's your give us a little bit on your approach.
Well, the approach itself obviously revolves around different portfolios coming together, right? So sure. like it's not like I just have one section, like I have a 10% for discretionary, I have a certain percentage for stocks, I have a certain percentage for just 100% systematic. Those are different systems built into that. It's a big process of like, let's say 10 to 15 different streams at any one time. So the diversification so one of the main things that's important in quantitative investing is to understand what diversification actually even means, right? Like people think that it means like, hey, I got a healthcare stock and I have a bank, right? And somehow that those things are diversified, like, which is ridiculous, right? It has to be not only just an asset. Like you could say like gold and oil, they move in opposite directions, but sometimes they move together and sometimes they move down to, you know what I mean? So there's no, I'm talking about like an actual system, like a system that trades something, and this is not a real system, but if you could find a correlation, say there was like a orange juice oil correlation you could trade, and then on the other side you're talking about the S&P 500, those two things are probably not connected, and then they would be non-correlated. And so my entire investment philosophy is trying to find those situations and trying to build systems around having that true diversification of, roughly 10 to 15 systems going at one time. and it can vary in lengths. I have long-term systems, I have short-term ones. I'm never doing high frequency trading though. I'm not doing anything that requires speed to be the advantage, just simply because I don't have the money or the space to do that.
Yeah.
Right, like I'm not making 1,000 trades every hour or whatever to get the discounts or to get anything. So everything I do is more on a swing time frame, like a 3 week time frame type thing. I'm never doing any type of HFT stuff. I'm never trying to be a liquidity provider, like I'm not trying to do that. And so most of my stuff revolves around that. On the discretionary side, I try to make them, I have a bunch of macro systems, and then I myself have studied macro my whole life at this point. So I write every morning. I have my plans, and when the system says I can do something that I already want to do, then that's when those two things then I would trade. So on that time frame, it would be anywhere from like 2 to 6 weeks. So my sweet spot is 2 to 4 weeks. I like to trade 2 to 6 weeks, and then I like to invest obviously on a much larger time frame. And the rest, the systematic side, I tried to build the systems and I just let it go. If I let it go until it stops working, and then when it stops working, I cut it and find a new one.
That is the way to do it. And kindred souls, by the way, because I get asked constantly, and 2 to 6 weeks, man, that's my money spot right there. It's I hate long-term investing. People love it, and people do it, and they kill it. I was joking with some traders this morning, and I said, Warren Buffett got it wrong, man. I don't care if he's worth $150 billion. Like, he just sat in stuff forever and ever. And of course, sarcastically, but
well, there's a good, with, I think Paul Tudor Jones just had an interview not that long ago where he talked about Buffett, and he had it, like, he said, I've done all these things and to not be, but Buffett wasn't really, he was just more of an idea, like a grand scheme thing. Like, I'm betting on America, and like if you give me a chance to own America, I'm going to do it. And like, it worked out, like you can't. So it just, if you could think very long term like that, obviously it can work out for you. But the thing about trading is, one, we never know who's actually the successful one. There's so many statistical things where someone we think is very good is probably not, and someone that blew up is probably fantastic, and he just caught a stream of bad luck, or just had bad, like people pulled their money out at the wrong time or whatever. There's all kinds of things in the investment game that make it much more difficult. And I would never say it's random, but there's a lot of randomness in it. And so you can really get into these periods of over and under performance that really have nothing to do with you. So, that's why the diversification stance. That's why I was never able to just do to watch one market all day, or to just trade ES, or to watch order flow or whatever. I needed those multiple streams. I needed to come up with a reason that I could maybe beat the market. And it's worked so far, thank God. I've done very well, but it doesn't mean it's going to continue. So I just have to stay on the hunt for that type of performance.
No, that's great. What are your favorite markets? What do you spend the most time? Are you more into futures? Are you into stocks? You said you didn't want to just do stocks. So are you trying to kind of be involved in all of them a little bit? How's that approach?
Well, I actually love stocks now. Like I make a joke, but I was like when I was younger, I was really frustrated that stocks didn't trade like macro assets. So I went and I learned FX. I went and I learned about bonds. I went on and learned about macro. And then after I was done with all of that, my favorite thing about stocks was that they don't respond to macro things. I like that long-term nature of stocks. Are based on earnings. They're based on forward projections, and the best opportunities in my life have come from when people have miscalculated on how important an Iran war is, or how important a tariff thing is, or how important, like, these are the times where the best performing assets for compounding your games, which is the stocks, you can get them in. But those times are far and few between, right? And so that's an investment side. I love to be an investor, but that's the investment side. when I look at the markets, I watch 15 different futures markets. And I picked 15 just simply because from like a trend following perspective, the amount of capital needed to run 15, like I can accommodate that. I'm never long 15 different assets, but I can accommodate, like 5 or to 7 to 10 different assets. I can be long, I can handle everything, the margins, like nothing's going to blow me out. Whereas like if you're talking about like a huge trend following model, you're following 100 assets, like you have to have institutional money to run something like that. You can't do it by yourself. And so the main markets I watch are obviously the stock indices, ES, NQ, RTY. I trade gold futures, I trade oil futures, and I trade the bond curve, and especially focusing on the front of the stir curve.
That is, and is that, so that's a combo of discretionary and systematic.
Yeah, correct. And the reason I picked those assets was simply because I tried to find the best assets I could bet on macro events with the smallest amount of capital. So like as opposed to trading every bond on the curve, picking a select few that respond to Fed events, that respond to different things that I could trade. Like I often will trade because I don't trade the 2-year that often, right? But a lot of people will use that as a proxy to the stir market. I actually trade the stir market, the OIS, and versus the stir, and then versus the long bond. Now I can actually kind of trade the curve with those two things, so I can get into different curve trades like that. Whereas if I had the capital and I was running a large amount of money, I would trade the whole thing, right? Yeah. But I can't because I'm just using my own money. Right? Yeah. Like so there's no way to do that correctly. So I tried to find 12 to 15 assets that I could trade, and that's the ones I trade, right? ES, NQ, RTY, GC, ZT, ZN, ZB, CL, and then the current couple currencies, USD, JPY, the euro, and those are the main ones that I focus on.
So in all of those, the futures market is one of the best. I mean, it's the easiest one for sure to see. Futures are not easy, but it's the easiest market to see when there's extremes, right? In sentiment. It's probably the most published sentiment extremes. When you look at the Commitment of Traders report, for example, and you see who's hedged and who's long and who's doing what. How much does that factor into your kind of decision? Do you look at sentiment like that? Are you looking for extremes, or is that not part of your analysis?
No, it's definitely part of my analysis. It's just one of my systems is specifically designed to do that. So if I have like a chart, you can go to my Twitter and look at it. I post all the time, and it has 4 systems that go into it. It has the price action, it has the sentiment values, it has the spread differentials between the different assets, and then it has the speed at which they happened. And then every morning I have a whole printout that comes out every morning in a report, and I look at that, and then I only trade in certain directions based on what this thing is saying I can do. So if it says and I look for overextension, I look for mean reversion, but only mean reversion from those extreme cases like you talked about. Those and I systematize it to the degree because I used to do all that stuff independently. Like look at the Commitment of Traders, look at this kind of stuff. But now I built the whole system with different feeds that go into it, and I put it all, the stuff that I can't get automatically, I put in every morning, and then it'll tell me those extremes. Just very similar to doing it yourself. I just have systems to do it for me.
Gotcha. That's great. When you think about investing, I was having this discussion earlier, and trading, especially when you're in that kind of 2 to 6 week window, do you find yourself more geared towards kind of a trend following, or are you looking for extremes, like whether it's a mean reversion extreme or this is the world's biggest dip to buy? Because essentially you're fighting the trend, right? And you got to have a good reason to fight the trend. How do you look at that?
Well, I'm a counter trend trader. So I look for the extremes in the other direction. I'm looking for some level of mean reversion, right? That's what I'm trying to time the most. That's where my biggest trades come from. From a trend following sense, the trend following would be, do I stay in the trade, right? Like how long do I stay into it? Like what type of trend am I looking for? One thing I'm never doing, which actually even trend following has got away from this, but I'm never playing breakouts, right? Like I'm not buying a breakout. Like that's just not how or sometimes a breakdown I will play, but like just a breakout trade I'm not really trying to do. I'm trying to time fear. I'm trying to time euphoria. I'm trying to time those things. And if you have a decent risk system to know when you're wrong and you can time those things, that's where I've done the best. And like uh, the last 2 Aprils, I've been very public about buying those dips. Like I was before, as they were happening, not just claiming it, as it was happening. And that's the exact thing. I track every stock I track all the stocks, but especially the S&P 500 stocks, like where they are relative to their averages, what are their earnings, what are this, and so every single system I had was bright green when it comes to the tariff sell off, right? So I bought everything, like I bought everything I possibly could. And I've been able to essentially stay in that trade since then. And so that's where trend following comes into play. That's what allows you to keep the money to not get out early. But like trend following itself, I'm not big into it as much, although a trend following gets lumped in with all CTAs and systematic things. So it's like in some way I am a trend follower, but just basic old school Donchian channel breakouts and stuff like that, I'm not doing that.
Gotcha. So trend following is more of a continuation signal than an entry signal for you. It's and that that's always an interesting point, because when you buy those big dips, right, when you're trading that reversion to the mean, um I always think it's interesting. Cheap can get cheaper, right? And
Yeah.
expensive can get more expensive, as we've all seen. Um, but I think it's a great time to reinforce that, you've got to have a system that supports those kinds of things. And it always has struck me funny how many times people don't like to buy the dip. And you are going against momentum, but when fear gets to extremes, right? When euphoria gets to extremes, and you have a quantitative way to measure that, that's such a powerful signal. I always love to tell people, if a Ferrari costs 500 grand and you find one for $100,000 and you're like, nope, don't want it. 50 grand, yeah. Worse. I definitely don't want it. Right.
Yeah, don't want it. Yeah, for sure.
It's so odd, but it goes into, and I think what you're saying here is you've got to put in the footwork, you've got to put in the work, and you've got to be able to formulate systems and reasons behind that. I think, this doesn't come up as much as it should in the podcast, in these episodes, but knowing the why is important. A lot of people say you'll never know it, and you've got to know the why. You've got to know why this is happening. And again, it won't ever be a concrete 1000% with complete assurity that that's why something is happening. But if you have a system that is repeatable, that gets you there, and likewise matches your temperament, because especially when you're trading your own money, and then especially, I have my risk tolerance, but I trade money for investors and they have their risk tolerance, and my fund advertises a certain risk tolerance. And so whether I want to stay in that or not, I kind of have to, right? And everybody kind of has to be within a certain area of comfort. Somebody else could trade your system and you could make money, and maybe they wouldn't make the same amount of money. Maybe they would have very different results because, risk tolerance changes and people get out of things when they shouldn't, or they don't let it ride as long as they should. And so I love that you have created a system that works well for you, and that, but also follows trading fundamentals. You got to make more money than you lose. And you have to have good reasons to do what you're doing.
And there's two things there. The first is you have to accept who you are. Like, I'm a pretty tough guy. I had a very hard upbringing. I was on my own very early in life. I was a professional fighter. So I kind of thought that I would have like, like iron balls when it came to trading. And then I got like 2 ticks profit and I was like, I need to sell it because it's going to give it back. Like it just wasn't me. Like I thought I was someone I wasn't. And then I had to admit to myself, like, hey, you're kind of a chicken shit about this stuff. Like like you don't have the balls that you do. Like if there's a war outside, you're gonna run into it. But when it comes to like losing your own money, you're not that good at it. You get frustrated. You get upset. Sure. And so that's one of the reasons I had to do it. Another great lesson I had about, like you said, buying the dip is one of my mentors. It was right in COVID, and I was short into COVID. So like I'm getting run over every day, and then eventually it crashes and I'm making a ton of money. So I'm feeling very good about myself. And one of my mentors, he buys the dip, and I'm like, bro, you cannot buy the dip here. Like, this is not the time to buy the dip. Like, you're going to get ran over. And he's like, Nick, the system says buy the dip. This thing has made me rich. Like, I'm going to buy this fucking dip. And they're like, I don't care if I lose the money. And I was like, bro, it's the dumbest idea you ever had. Like, go ahead. And then so sure, he does it, and he got stopped out the next day. I think he lost like 20% in a day or something, just something ridiculous. And so he's like, all right, I'll just buy the next one. And then so it comes around and he buys the dip again. And it's the absolute COVID low. And so he got stopped out the one time, and then he nails the second one. He takes both trades, and then he made an ungodly amount of money. Yeah. And I was short into it, bought the dip on the lows when he bought. Then I shorted and lost some of it. And then I tried to be cute and lost a little more. And then I tried to buy the dip and it kept dipping. And then by the end of it, me being short into COVID, I made like 10%. Right. And he made he could have retired 10 times over. He was already retired, but he just printed money. And it was a good lesson as to, like, if you have a reason to do it and you're willing to take the loss and your system says to do it, just do it. And then you buy the dip, right? And he essentially knew he was going to lose the money, and then he still did it anyways. And it's like, that was a very powerful lesson in like the why you systematize stuff and why you take the bets, because you never know. And I kind of felt that way during the tariff drop, because everyone's telling me that it's over, and I'm investing all my money possible at the lows, and yet it worked out. You know what I mean? I mean, but I've had some bad days too, where I did that, where I was like, the system says do it, and then the next day I lose 10%. So, when the big ones come, you have to swing. And so that's the other thing. If you run a system and you don't swing at the pitches that you need to, then it's not going to work. And so you have to be willing to lose the money. You have to be willing to take the bets, and you have to just try and hope luck's on your side every now and again.
I think that's great. I love it. I think knowing the why, following your system, having a system, and whether you're, whether you're somebody that wants to code some automation, or you want to be discretionary about it, whatever your approach is, you have to have a system. Just because you're discretionary doesn't mean you don't have a system, right? And if you don't have a system, then yes, you'll lose all of your money, right? And so you have to have a plan and a system, and then follow it. And I think you nailed it right on the head. I think that's so great. And have the guts to be able to take those trades when it's hard. I mean, I like I say, I'm old enough to remember the COVID dip, and I'm old enough to remember the 2024 and 2025 April dips. Those were wild moments, but and those are hard to buy into. But if you can't in those times, then you miss out on so many great opportunities. And trading is full of these. I mean, I think we've all heard the statistics, but if you miss kind of the 4 or 5 opportunities in a year, that could be the significant amount of your profit, no matter how active you are from day to day, right? It's usually a small handful of opportunities throughout the course of the year that make the majority of your money. And, whether you're in and out, I mean, you and I have similar durations on our trades. Even with that, there's still a couple of big bangers out there. And so you have to, the old saying, man, life's about showing up, and you got to show
Yeah.
up and,
You gotta
and
show,
take
you
a,
gotta show, you gotta show up when it counts, and you have to take the shots when they're there, and you
uh,
gotta just find the way that makes it so you can do that. And like I said, I even know very well that like I don't really know the odds. I just know that statistically, I think that this is going to work. That these systems line up. That this is a one, like the system that fired on the tariff lows hadn't fired for 2.5 years, right? Like it did, and then two and like so it doesn't come around that often, and
yeah,
it's measuring SPX breadth. It's measuring how many of the stocks are like what the volume is to the downside, how many of the stocks are under their moving averages. Like it's a complete washout. Like the people who didn't sell at that point are people that are never going to sell because they don't even know it's there. You know what I mean? Like they're it's in a retirement fund. Anyone who was a
yep.
discretionary trader had sold. So there's no one left to sell. And so like it's could I have gotten stopped out? Yeah. It would be like buying when the tech bubble blew up. I mean, there were plenty of signals there by the dip, and people don't remember this, but like a lot of those paid off pretty good. Like you bought it and it went up like 50%, but then it crashed back down. So like if you have like a 30% gain and you give it back, like well then you're just a sucker anyways. But so there you can time bear markets to a degree, right? You can buy dips the whole way down. And that's another thing that I got away from is I've actually done pretty well on the short side, but when it came to shorting stock indices, I just didn't like the way it made me feel. And I always felt like it kept me away from buying the dip because it's like, oh, this isn't enough. I always had that battle. I was like battling myself. Whereas now I really try to focus more on the long side. Except for I focus on the long side almost on most things except for currencies, just because currencies are a little different, but especially in stock indices, I'm rarely trying to short anything these days. I'm just trying to time dips, and then if I get in, I'll just set the stops, and then if it stops me out, so be it. But that's just sort of that mentality of knowing who you are, and the only reason I know who I am is because of how many freaking mistakes I've made and tried to break all the stuff in my house, and going to bed, like and not sleeping and wasting all my money and doing all kinds of mistakes like that. So
For sure. These are important, valuable lessons, just 100%. So that's great stuff. Tell my listeners where they can follow the journey and keep an eye on what you're doing.
You could just look at Nik Lentz. It's at NIKLENTZ. And then also we run a service, me and Andy Constant and Jimmy Jude, we run a service at dampspring.com. There's all kinds of different things you can do there. And then just reach out anytime, if you have questions or if not, or if you just want to shoot the shit or you want to tell me I'm wrong, I welcome it. So bring it on. I look forward to hearing from everybody.
That's awesome. Well, thanks, Nik, for being on with us. This was a great discussion. I appreciate your insights and sharing your journey and your experience with us. And I know my listeners will love it as well. So thanks for taking the time today.
Yeah, cool. God bless, guys.
Thanks. Take care.